What is up, you absolute tape monsters? We are live, the world's on fire, and I'm here with the quiet assassin, TB. Overnight gave us an Apache shot down over the strait. Crew ejected safe, then both sides lit up the water. Iran hit bases in Bahrain and Kuwait and Jordan, and while that was happening, Trump says a deal is days away, and Israel's chief of staff says, prepare for heavier strikes. That's the whole session in one tension. Futures are bleeding. VIX is at 20.49, the Qs tapped 686 overnight, and we haven't even rung the opening bell. TB, take us through the tape.
Quick note before we go any further. Nothing we say here is financial advice. We're two guys with strong opinions and no fiduciary duty. Do your own homework before you put a dollar anywhere. That said, the tape is pricing a supply shock and a flight to safety in real time. S&P futures are down 30 points, the 10-year is back above 4%, and the VIX isn't just high, it's sticky across the curve. That's not one-day panic, that's premium building in.
Breach. The VIX curve is backwardated in the front month and elevated all the way out to December. That tells you options. Traders aren't betting. This blows over by lunch. They're pricing months of headline risk. And I haven't even gotten to the bond market forcing Warsh's hand tomorrow. This entire session is a powder keg. Let's break it down.
Top stories. Start with Iran. That helicopter shootdown was no accident. An Apache went down, crew is safe, but the response was immediate and bilateral. Iran hit Bahrain, Kuwait, Jordan. Then both sides stepped back, and now we're in the pause. The oil market added a $12 war premium in 2 weeks, and we're sitting at $88.05 a barrel. The second-order effects on semiconductors and defense are huge. Raytheon, Lockheed, Northrop all spiked pre-market, and TSM is down another 4% this week because if the strait closes, chip supply chains choke from petrochemicals to electronics, grade gases.
That's the industrial spine of the whole artificial intelligence trade getting squeezed at the neck. People think semiconductors are just silicon and software, but you can't make a chip without high-purity chemicals that mostly ship through the Persian Gulf. The supply shock isn't theoretical. It's already in the lead times. And while that's cooking, China dropped their inflation data overnight, and TB, you said this is the margin squeeze story the street is missing. Break it down.
China's PPI, the Producer Price Index, came in at 3.9%, the highest since 22. That's factories paying more for raw materials, energy, metals. But the CPI, the Consumer Price Index, missed at 1.2%. That means Chinese consumers are not paying higher prices. The pass-through is broken. So, manufacturers in China are absorbing higher input costs without raising output prices. That's a margin headwind for anyone producing in China and selling to Chinese demand. Now extend that, Korea sits right between China's cost base and global end demand. Korean chip makers and battery makers buy Chinese inputs and sell to the world. If input costs rise and global demand wobbles from a supply shock, their margins get crushed at both ends. That's why kosPI didn't just dip, it collapsed.
I called this unwind on June 8th. It's June 10th, and kosPI just printed another 4.52% overnight. That's the carry trade coming home in a body bag. Here's the mechanics. Hedge funds borrow yen at cheap rates. Sell yen. Buy Korean equities to capture the spread. When the yen strengthens or Korean stocks dump, the trade loses money, and they have to unwind. They sell kosPI, buy back yen. That yen buying forces the yen higher, which hurts more carry trades, which forces more selling. It's a feedback loop. And because the same desks have Korean equities hedged with NASDAQ futures, the selling spills directly into US tech. Qs hit 686 overnight. That's the low of the year. This is mechanical, not fundamental. It's leverage unwinding.
Sad, right? And now all of that feeds straight into tomorrow's CPI print. This is the binary event of the quarter. Consensus is headline CPI at 4.2%, core at 2.9, month-over-month core at 0.3. The bond market is already positioned for hawkishness. If Warsh blames the war and calls energy inflation transitory, the 10-year rips higher and he loses credibility with bond traders. If he takes ownership and sounds hawkish, equities crash into a live geopolitical tail risk. He's in a no-win spot. The only thing that matters is whether he blames the war or takes the hit.
You nailed it. If he says supply-driven and likely temporary, he's leaning dovish, and the bond market eats him alive. If he says we must anchor inflation expectations, he risks a crash. I think he tries to split the baby and says something like, we're watching the data closely. The path of policy will depend on the data. And that makes nobody happy. Both sides read it as weakness. The actual print matters less than the tone. But if the number comes in hot, say above 4.2, the bond market forces his hand and he has to talk tough. My paper account is not adding risk into that.
Neither is mine. And the economic calendar tells you why this day is loaded. We already got China's numbers. NFIB small business optimism came in at 96, flat versus last month, and Atlanta Fed GDPN now is holding at 3%. Overnight Japan PPI printed at 5.6%, hot. Lagarde speaks later today. Tomorrow it's all CPI, and Friday we get the ECB rate decision, expected cut to 2.4% plus US PPI. The whole week is a chain of macro triggers.
So earnings this week? Actually, we've got Oracle reporting after hours today and Adobe tomorrow, not a ghost town. And honestly, that's a blessing. No distractions from the macro smoke. Let's talk about where that smoke is pushing money, because the sector rotation board is screaming.
I've got it pulled up. Healthcare XLV up 4.5% in 1 week. Real estate XLRE up 3.93. Consumer staples XLP up 2.52. On the other end, consumer discretionary down 1.96, communication services down 3.57, and technology, the tech sector, down 7.6%. That is the widest spread between the best and worst sector since this war started. It's not a slow rotation, it's a fire drill out of tech and into safety.
Capital is evacuating. And you know what that means for our engines, TB? This is where we introduce the CTS experiment live on air. Because the engines trained on 8 years of backdata never saw this combination. I'll pitch the experiment. You bring the skepticism.
Go ahead.
3. All right, the CTS experiment. It's a live track we're running where we score 8 trading engines every day, 0 to 10. 0 means do not turn that engine on today. 10 means allocate max capital. The engines include my TFT Algo's pullback engine and mean reversion engine, plus TB's Wave Trader Algo, plus others. We score for fit to today's specific tape, not who built the best engine. The experiment has 2 tracks. Track A is a lookup table, just historical backtest scores. Track B is our real-time human scores, combining our pattern recognition with the algo outputs. The question is simple. Does human judgment added to algos in a live war, a new Fed chair, and a 4-year high PP, I beat a backtest that never saw this day coming?
And that's exactly my skepticism. The backtest window covers 8 years, 20's COVID crash, 22's rate hikes, a couple of trade war flare-ups, but it never includes a Strait of Hormuz blockade, a helicopter shootdown turning into a regional shooting match, and a freshly appointed Fed chair getting tested on his first inflation print while the bond market is already pricing rate hikes. The machines have zero historical analog for this. That gap between the training data and the live tape is the whole experiment. I don't know if our human judgment adds value. That's why we're tracking it.
And that's why I'm scoring my TFT Algo's Surge engine a 2 today. The algo sees momentum and volatility, but it doesn't see the war. My gut call paper account, on the other hand, is still long energy because the thesis is supply destruction. The disagreement between the algo and my stomach is the trade. That's the content we're going to surface every day.
For transparency, my Wave Trader algo is small in OXY, Occidental Petroleum, entry at 56.55, stop at 54. I also hold BYD, the Chinese electric vehicle name, at 87.77 with the stop at 82. Combined exposure is about $3,000 against $6,900 in cash. I'm not adding into CPI tomorrow. If OXY holds above 55 through the print, the energy thesis has legs. If it breaks, I'm out.
Walk through my book. My TFT algo went to cash last week, but my paper account is long energy. I've got the energy sector, ETF. The energy sector ETF, bleeding $23 unrealized on a $2,000 position. I'm not selling. The thesis hasn't changed. I've also got a limit order on ExxonMobil, Exxon, at 147.50, untouched. If oil stays above 100, Exxon grinds higher. If it doesn't, I don't get filled, and that's fine. The bull case is simple. Straight risk keeps supply tight, energy earnings get a tailwind, and capital fleeing tech needs a home. The bear case is a ceasefire and a demand drop. I'm positioned for the bull case, and I'm not adding risk tomorrow. Let the position breathe.
So both our books are light, defensively positioned, and anchored to energy. That's exactly the great rotation playing out in our own accounts. Now let's connect this back to the international plumbing, because the Asia session overnight fed directly into our tape.
Do it.
Nikkei down 1.89%, Hang Seng down 0.64%, Shanghai down 0.42%. But the big one was kospi down 4.52%. That unwind I described is real time. The carry trade mechanics, USD JPY is barely up 0.04%, but the yen has strengthened sharply over the past week. That tightening is squeezing the hedges. When those Korean positions liquidate, it hits the NASDAQ futures because those are the primary hedges. So Q's at 686 wasn't random. It was a direct spillover from Seoul.
And Europe was a shrug. DAX down 0.25%, FTSE flat, Euro Stoxx 50 down 0.1%. That tells you the anxiety is still contained to Asia and the war premium, but hasn't gone global yet. The macro plumbing is on a knife's edge. If the yen breaks 140 to the upside against the dollar, and kospi can't hold 2,380, the unwind accelerates, and you'll see a correlated sell-off in US megacap tech. That's the scenario we're watching.
Exactly. And that intersection of Asian carry trade and US tech is why we're both holding energy names. The rotation isn't noise. XLV up 4.5%, the tech sector down almost 8% in 1 week is the market voting with its feet. The machines may not have seen this before, but the message from price action is loud.
Here is the takeaway for our trading family. The market is pricing two realities at once, one where the war ends and rate cuts come back, and one where the war escalates and the Fed hikes into a slowdown. Both cannot be true. Tomorrow's kospi forces the first resolution, but the war narrative won't settle for weeks. We have positions that lean on energy supply tightness. We have stops in place, and we are not adding risk into a binary event.
Here's what we're watching tomorrow. Number 1, the CPI print at 8:30 a.m. If headline comes above 4.2, the bond market lights up. Number 2, ExxonMobil at 147.50. A break above that resistance drags the whole energy complex higher. Number 3, Occidental Petroleum at 55. That's the level that holds our thesis or forces me to hit exit. Number 4, kospi holding 2,380. If it fails, the carry unwind spills hard into US tech. Watch those levels.
They are the four corners of the cage we're in. We'll be back tomorrow with the damage report. Until then, trade small, protect your nuts, and don't let the tape catch you leaning the wrong way. We're out.